If you just watched silver lose nearly $14 per ounce within only a few hours and felt that something was off, that instinct is correct. There was no new economic data, no geopolitical shock, no sudden reversal in industrial demand. The only thing that changed during that window was the trading rules. And when rules change, markets do not pause to reflect. They react instantly. The problem here is not that silver's price declined, but the speed and ease with which it could be dragged lower at a time when gold, silver, the US dollar, and foreign exchange markets are increasingly driven by operational mechanics rather than by pure supply and demand. After a nearly $14 drop in just a few hours, the natural reaction for many is to search for a familiar economic explanation to hold on to. An unexpected inflation report, a monetary policy signal, a geopolitical shock. Yet the more one searches, the clearer the anomaly becomes. No sufficiently significant data emerged during that period to justify a move of that magnitude. Industrial demand does not disappear in a single morning. Global silver mining capacity does not change within hours. The only thing that truly shifted was the way the market itself was being operated. This is the point that many retail investors tend to overlook, not due to a lack of intelligence, but because they are trained to view markets through the lens of price, rather than through the structure that produces price. In the modern silver market, the majority of trading does not occur in physical metal, but in contracts. These contracts allow control over very large quantities of silver with only a small fraction of the nominal value through leverage. When conditions are stable, leverage creates liquidity. When conditions change, that same leverage becomes the catalyst that amplifies reactions. When margin requirements are adjusted, the market has no time to think. Positions must rebalance immediately. This does not reflect a new belief about silver's intrinsic value, but a colder reality. Participants who can no longer meet the new requirements are forced out. Selling pressure arises not from opinion, but from obligation. And when obligation is triggered in a highly leveraged market, speed always overrides fundamental analysis. If this sounds familiar, it is because history has seen this pattern before. Periods of rapid silver advances followed by sharp reversals have consistently shared one common factor. Price moved into a zone highly sensitive to market structure, and then trading conditions changed. There is no need to attach moral judgments to this phenomenon. What matters is recognizing that precious metals markets have never been purely supply and demand systems, as many believe. They have always existed at the intersection of finite physical assets and a financial system capable of near unlimited expansion at the paper level. It is precisely here that a paradox begins to emerge. While prices on screens fall rapidly, the physical world behind them does not move in parallel. Physical silver cannot be created or destroyed simply by adjusting a trading parameter. Mining, refining, transportation, and storage do not operate on minute-by-minute or hour-by-hour timelines. When paper prices are pushed lower by mechanism while the physical world maintains its inertia, a gap forms. That gap is not loud, but it is persistent, and it tends to widen during periods of stress. At this stage, focusing solely on price charts becomes insufficient. The broader monetary context must be brought into the analysis. The US dollar is operating within a prolonged environment of fiscal expansion, while monetary policy is continuously forced to balance inflation control against system stability. In such an environment, gold and silver are often described as defensive assets. What is discussed far less is this. When capital seeks defensive assets through leveraged instruments, the trading structure itself becomes increasingly fragile. This tension does not reveal itself immediately. It accumulates gradually until a technical adjustment, normally considered routine within market operations, becomes the ignition point. At that moment, what the market expresses is no longer the question of how much silver is worth, but rather, how much pressure the current system can withstand. This is the core of the issue. The real question is not why silver's price fell sharply within a few hours, but why it could be pulled so quickly without any corresponding change in the physical foundation. When framed this way, the discussion shifts away from short-term price action and toward long-term pricing structure. From an analytical perspective, this content is not intended to predict whether prices will rise or fall next. The focus is on identifying which mechanisms dominate price behavior during periods of stress. It is the interaction between derivatives markets, monetary policy, fiscal policy, and the role of assets such as silver and gold within the modern monetary system. The recent volatility reflects the sensitivity of a leveraged trading system rather than a fundamental change in silver's economic role. Evaluated cautiously, moves of this nature often appear when markets approach the tolerance limits of their existing structure. This does not imply a predetermined future outcome, but it does impose a clear requirement on observers to distinguish between movements in price and movements in the system that generates price. And this is where the discussion opens. When you look at what just occurred, are you witnessing a necessary adjustment that allows the market to continue functioning, or signs of a structure increasingly dependent on intervention to stabilize itself? Are you watching the price of silver, or are you observing the level of stress within the financial system behind it? These questions do not require immediate answers, but asking them is the core value of the analysis. If this content helps you see markets not only through numbers, but through the mechanisms that drive them, then it represents a meaningful step forward in understanding the US dollar, foreign exchange, gold, and silver in the current environment. This is precisely why silver's nearly $14 decline should not be viewed as an isolated incident. It means that today's prices are reflecting how the system operates more than the intrinsic value of the asset itself. When the rules of the game can change faster than supply and demand, what truly needs monitoring is not the chart, but the pressure accumulating within the global monetary system. In the broader picture, from expansive fiscal policy, selectively tight monetary policy, to the historical role of gold and silver as instruments for preserving purchasing power, we are witnessing a familiar transitional phase in monetary history, quiet but consequential. Periods like this rarely conclude within a single day or a single week. They begin with questions, not conclusions, and this may only be the beginning of a phase in which markets are forced to recalibrate how they price risk, leverage, and defensive assets. No one knows the precise timeline, but the direction of pressure is observable. How do you think this will affect how markets perceive silver, gold, and the role of the US dollar over the next several years? Your perspective is worth discussing. This is Money Cycles, where we dive deep into how financial systems actually function. If you want to continue following analyses like this, you know where to find us. The future of prices is uncertain, but understanding can always move ahead.